All right, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we've got a special episode where I'm going to be answering a few questions on Qudian and Weibo. So this episode's all about you guys, my subscribers, and I'm going to be answering whatever questions that you might have. And yeah, so if you guys have any questions, feel free to drop them in the comments below, and I'll hopefully answer all of them in a future video if I don't get them answered today. So guys, to kick off the video today, I just wanted to give a quick shout out to a couple of my subscribers, Max and Shawn. You guys have sent through some really good questions. So what I'm going to do is I'm going to be spending the rest of this video answering your questions. Before we get into this video, guys, I just want to again remind you that this is just my opinion from the research that I've done, which obviously isn't financial advice. And I know that it's good to, discuss these things in the open, but really, if you want to do any sort of investing, you really should do your own extensive research and, obviously speak to people more qualified than myself, right? So none of this is financial advice, just my interpretation of some of the things that I found during my research. So first of all, we're going to start off with Max's question, which is to have a look at whether I think the recent PBOC stimulus and the sort of ongoing stimulus that people are forecasting the People's Bank of China to have, how that's going to affect Qudian and whether that's, I guess, affected them in terms of the recent price sell-off, and whether I think that city might be, doing some sort of price manipulation to try and accumulate. Then, Shawn, thank you for writing me an email. So Shawn's actually sent in a huge list of questions. So after I answer Max's questions, we're going to answer some of Shawn's questions, which is the following, right? So his first question talks about the transaction size of Qden and whether we're talking about the actual ticket size that includes the fees, the APR, or whether it's just for the ticket size. And then he had some questions around, how comfortable I was that Qdian's borrowers will be able to actually repay the amount that they borrow, and what are some of the things that the company can actually do to ensure that people do repay, and what happens if they don't repay, right? So he had some concerns around that. His second question was, around sort of the China itself being a communist dictatorship, and whether there was actually any way to enforce the collection of payments if people default. Then his next question focused around Qdian taking on a bit more leverage in terms of growing, right? So taking on more risky loans, and why they sort of can't just plod along, and why they're sort of targeting this aggressive growth and taking on more risk. So we're going to talk about that as well, right? So we're going to answer that. He also had some concerns about the provisions going up and whether the company is liable to pay these provisions. And he also had some concerns around, whether Qdian will actually be around in the long term, because he's just trying to understand what the difference between Qdian and a credit card is, and why somebody would take micro lending services from Qdian rather than just go to the bank and get a credit card, and what the reason behind that is, right? So again, this is a really good question. His next question talks about why people in a communist country even needs credit in the first place. So we're going to be talking about that too. And then he also had some questions around Weibo and what kind of returns it would require to justify that as the fair value or intrinsic value. And then he also talked about buying Weibo at a sort of 50% margin of safety, and whether it can maintain a growth rate of 15% or more, or 16%, to justify that value. Then he wanted me to just do a bit more clarifying in terms of looking at whether Weibo actually really has a moat, and if they have a moat, how strong is that moat, and what's going to prevent the users from leaving the platform. And then finally, he had some questions around whether I had any other thoughts on other Chinese companies, and my thoughts on these publicly listed Chinese equities being taken private again. All right, so guys, we have a really loaded video for today, so I'm going to get into these questions one by one, and we're going to start off with Max's question. Okay, so the question was around how the recent stimulus and interest rate reforms will affect Qdian, okay? So there are a couple of things that I wanted to talk about. First of all, it's the Chinese government bringing down the LPR rate. And then the second thing I wanted to talk about is, obviously China doing a lot of stimulus, which is devaluing the yuan. And the reason why they are doing this much stimulus is, obviously because they want to maintain the GDP growth rate, at above 6%, to keep it between that 6 to 6.5%, because the GDP previously had slid from 6.4 to 6.2, and obviously the government's panicking and not wanting to drop below the key 6 level, right? So guys, my answer to this first question is that I actually think the stimulus is going to benefit Qdian, because it's going to make credit cheaper to give, and it's going to make lending standards less stringent, so it's going to make it easier for people to borrow. Now we have to understand, so Qdian's loan value, right? It's absolutely tiny. We're talking about 4, 5, 6,000 RMB, not exceeding that. Okay, so we're not talking about them needing to lower their APR, which is 36%, right? Because I think what Max is saying is that he's concerned that they need to lower their APR and that's going to affect their profits. But look, when it comes to loan values that small, right? We're not talking about a big, $1 million of mortgage at say 4%, and then you drop it to 3.5%, right? We're talking about 8, 9, 10-month long transactions of cash, or I guess higher purchases at an APR of 36%. Now I'll be very surprised if Qdian have to lower their APR because of this. In fact, I actually think the lower rates are going to help them, because it's going to make it cheaper for their funding partners to borrow, but they can still use Qdian's algorithms to lend it out at 36% APR. So really, I think the stimulus actually helps them, right? So because look, we're not talking about China going to go completely broke. We're just talking about them doing stimulus to maintain the GDP growth at above 6%, hopefully keeping it that 6.2 level and then bringing it back up to 6.5, guys. So we're not talking about the country going broke and people can't repay. We're just talking about the country trying to meet their GDP targets. Okay, so that's it. Okay, second question is Citi shorting? Look, I've got absolutely no idea. They probably are. These big institutional banks always like to short stuff. Who knows, right? But we as investors, we have to remember to focus on the business and the fundamentals of the business. And as long as, we believe that the business will be okay due to our deep research, right? Because I genuinely believe Qudian is still going to be good for at least another 2, 3, 4 quarters, and they're going to still maintain that 50% bottom line growth. I don't really have a problem with Citi shorting, right? Because maybe they see that it's undervalued, they're trying to accumulate, who knows, right? So what the institutional banks do doesn't really bother me. What bothers me is that if something fundamentally goes wrong with the company and I'm still in the stock, that bothers me, right? So I hope that answers your question, Max. Okay, first question Shawn had is, what's included in a transaction? And so the transaction value includes the borrowed amount and the APR, okay? So Qdian only charge one fee, and that's an all-inclusive up to 36% APR, which includes all interest fees, transaction fees, whatever fees, right? So the amount, the fees, that's the transaction volume, and then the borrowers repay that over the course of 8, 9, 10 months. The second question is, does Qdian assume any obligation to repay funding partners? And the answer, Shawn, is yes, they do. Now, just to clarify, so for their direct platform, their direct lending platform, where they facilitate the transaction between the institutional lenders and the borrowers, yes, Qdian guarantee in part or in full any defaults. Okay, so that's why if you read their 10Ks and the 10Qs, you'll know that they have a set amount per year as a provision. And that provision is basically based on their algorithms and their calculations of what the likelihood of default is. They've set that amount aside as cash or restricted cash to potentially pay their partners if anything happens with the transaction, okay? But for their open platform, they do not. So that's a 100% risk-free, and all they do is they basically say, look, we've done the credit analysis. You guys choose whether you want to lend it to them. We're not going to make any recommendations, but this is our analysis, okay? So here's your risk reward, right? Now, the difference between the two platforms is the take rates. So the open platform is 100% risk-free, but the take rate is lower, right? On average, it's about 7%. The direct referral platform is 12 to 15% in terms of the take rate, but again, they are liable for anything that goes wrong. And so if we think about Qudian's most recent call, which is the Q2 2019 earnings call, you'll notice that the CFO has projected that most of the growth for their future, they want it to come from the open platform. Yes, it's a little bit less profitable, but there's zero risk. Okay, and I think that's a very smart move. How likely will people repay? Well, the answer to that, Shawn, is very simple. You basically look at their delinquency and charge-off rates for their loans from M1 to M3 to M6, and it's also got the previous vintage rates, okay? Now, before they tapped into their sort of dormant 40 million odd user base, it was about 1.5 to 3%. And this quarter, it's climbed to 3.5 to 4.5%. But they've also reduced the values of the loans and also the tenure. And the reason being is because, like the CFO said, is that they're trying to now experiment with tapping into the 40 million that they aren't serving at the moment, because they think that that's going to be absolutely huge. And I don't think they're going to tap into the 40 million users by, direct lending. I think what they're doing is they're experimenting to a point where they can say, okay, great, we know who's going to repay how much, what, when, and we know how much they're going to buy, and we know what the repeat borrowing rate is. So as a result, what we're going to do is we're going to take that 40 million and then add that to our open platform. So that's what I think they're going to do, which I think is huge. We're talking about short-term pain for long-term gain. Yes, delinquency is going up, but you got to remember, their net profit is increasing 50% year on year. So it's kind of like almost an investment, right? They're losing a little bit here to get valuable data and analytics insight into how these 40 million people with no banking records, no transaction history, nothing, right? Nobody knows anything about them, and yet they're trying to sort of get a full understanding of them, because these are your Gen X, Gen Z, Gen Y, you name it, right? These are all of these valuable millennial customers who's going to do the majority of the borrowing many, many years down the line, okay? So, again, I don't think they're going to have a problem to repay. Maybe their delinquency will go a little bit up, but I think it's going to come like this, and then it's going to come down once they get the algorithms right. So what can Qudian do if borrowers do not repay? China is, and it isn't, a dictatorship at the same time, okay? Qudian is not a government entity, and they're not connected to the mafia. So like any credit organization, if the borrowers don't repay, they're buggered, right? They're screwed. So that's why they have to be very careful at the front end to do all of their careful risk analysis to make sure that they understand exactly what the likelihood of default is and how much they can afford as an at-risk portion to still make the money and the margins that they want. So if we read into Qudian's 10K and 10Q, we'll understand and also listen to the earnings calls that they do not do any violent collection methods, okay? So their methods of collecting are by phone, by SMS reminder, and by emails, okay? How this ties back to whether China is or isn't a dictatorship, we have to understand. So politically, China is communist and dictatorship, quote unquote. But in reality, if you actually, go to the country, live there for a bit, see how things are run, you'll realize that it's actually a very capitalistic society. Otherwise, there'll be no privately owned companies and everything would be nationalized, okay? You wouldn't have billionaires like Jack Ma, and you certainly wouldn't have entrepreneurs like Min Law, who's the CEO of Qudian, creating a micro lending company, okay? There will be no such thing as, free business or free market, or I don't know if you can call the market free, but you know what I mean, right? People wouldn't be able to make a profit, and you wouldn't have millionaires. It'll be just like North Korea, okay? That is a true dictatorship. China is it's like a quasi-dictatorship, communist, but not really. Like, you can still do business. There's a lot of corruption, all of that stuff, right? So I hope this sort of helps to clarify the difference between a true communist dictatorship like North Korea and China. I'd encourage everybody to just do a bit of research on whether China is actually truly a communist country or whether they're a capitalist / communist country. And I think that's going to clarify a lot of confusion for people who have concerns about China being, I don't know, maybe similar to North Korea. Who knows, right? Okay, next question. So Shawn asks, why is the company taking on more risk? Why not just sort of plod along and be profitable? And again, Shawn, I would encourage you to carefully read the Q2 2019 earnings call transcript. You can get it for free on Seeking Alpha. And similar to what I said before, they've got 40 million users just sitting there that nobody knows anything about, okay? So it's a little bit like a black box mystery. Now, if we think about them regularly serving 6 million users per quarter, and they've got over 300 billion borrower data points, which means that since they've launched, they've completed almost 300 billion transactions. This is all very valuable information. So my question to you is, how much can they sell this information for, and who's going to want to buy this information, okay? Now, as a result, like I said before, I think what they're trying to do is they're trying to get, 3, 4, 5, who knows, maybe even 1 trillion data points of information from the 40 million dormant users. Because again, we have to remember, banks don't have information on these people. These guys are the unbanked and the underserved and the underloved, okay? No credit history. But these guys are going to be, so they're going to be the future working class. And so the banks want to lend to them somehow. And I think this is where Qudian comes in, okay, guys? So just remember, Qudian is not a microfinance company, okay? I think that's the biggest misconception. They are a business analytics and data intelligence company disguising themselves as a microlender. We have to remember that, okay, guys? Why are they increasing their risk? Well, the answer is they can afford it, right? They can afford to take on more risk because they know that the upside, the data, the value of the data on 40 million people, just think about that for a second, 40 million people, no banking history, no credit history. If you can predict how each one of those 40 million people, how much they'll borrow, when they'll repay, the likelihood they'll repay, if they'll borrow again, how much can you lend to them in 5 years' time? If you can predict all of that, how valuable is that data, right? So I think them bumping up the default rate a little bit so they can get this data, this might, that might be their company for the next 5 years, continuing to grow at 50% per year for the next 5 years, right? Because this is all very valuable stuff. This is a calculated risk that they're taking, and I'm very happy they're doing this, right? Because and we can't be scared when we're trying to venture into something that people haven't done before, right? So this is entrepreneurship. We have to have balls, but we have to have brains as well. And I think that this is a calculated risk that they're doing to secure their future for the next 5 years. Think about Facebook. Think about Google. Okay, think about these big tech companies. How many loss-making units do you think they have? And why do you think they continue to have these loss-making units? Or even think about Alibaba. The majority of Alibaba's divisions are loss-making, right? But yet they continue to invest. Why is that? What are they trying to achieve? So let's take off our value investor hat for a second and put on our entrepreneur hat. And I think the answer will come to you. Now, Shawn asks, why do people in a communist country like China need credit? And again, the answer to that question is China is a communist, but really it's not communist, right? It's capitalistic and materialistic. Now, remember, okay, if we think back to the video I did on Alibaba, China wants to decrease their manufacturing drastically and increase the contribution towards their national GDP from services, okay, to 70%, right? They want to match the USA and other developed nations. So in order to do that, people need to consume, okay? People need to consume more than what they need and more than what they want, right? People need to, embrace this sort of greedy consumerist type mindset and behavior. And so as a result, that's why China isn't communist, right? Because in a communist country, this doesn't happen, okay? If you look at somewhere like North Korea, the middle class doesn't even exist and people can't even afford to eat, okay? Now, the other thing that I have to say to that is, if China was a true communist country, again, there'll be no stock market, there'll be no USA listed stocks, there'll be no luxury brands, none of that shit, okay? So that's why, look, I don't consider China a true communist country. I would actually encourage you guys to just do a bit of research on how materialistic China truly is. Okay, for example, getting married in China, it's almost like doing business, right? You can't be over 27 if you're a woman, because if you're over 27, you're too old. You're the leftover riffraff. And then if you're a man, you must have a degree, a car, a house, good education, all of that shit, right? Personality doesn't matter. Okay, none of that matters. And so the more you dig into it, the more you'll realize China is a truly, truly capitalistic, materialistic country, and they're just putting on the front of communism, right? The government is communism, but the rest of the country isn't. That's the reason why China needs credit, because people are going to consume and spend and buy things to make themselves feel better because they're materialistic, and they're going to try and live above their means, and that's why they need credit. The next question. Shawn goes, well, look, why do you need Qudian if you have credit cards, okay? Well, the thing is, the banks need Qudian. And I'll tell you right now, so if we think about the population of China that isn't banked, okay? About 460 million people in China have no credit histories, okay? So no credit histories, no banking transaction records, nothing. Now, if you think about these people, who are they? Well, the majority of them are people like us, right? Or people even younger than us. You've got your millennials like me, then you've got your Gen Ys, people born sort of 1995. Then you've got your Gen Xs, people who are born in 2000s. Okay, and the banks have no idea what to do with these people, because 10, 20 years from now, these people are going to be your working class, right? These people will be like our mums and our dads. These people will be making 6-figure, 7-figure salaries. These people will be people that replace the old working force or the old workforce to become the new workforce. Okay. Now, obviously, the banks want data on these people. Okay, 460 million people with no banking histories. So my question is, how are you going to serve them? Right? You can't not serve them, because then how much money are you leaving on the table? But then if you want to serve them, you don't even know what your risks are. I mean, these people don't have banking records, so what are you guys going to do, right? Now, the bank is not obviously not going to hire a whole lending team to do manual assessments on these people, because then their margins will plummet and they'll become loss making. Okay, it's simply just impractical, and that's where Qdian comes in. Just remember, guys, Qdian has over 300 data points for lending to mostly millennials, Gen Y, Gen Zs. Okay, these data points are extremely valuable. Just because the people are unbanked does not mean they're not creditworthy, okay, guys? And just remember that. Qdian can do over 11,000 transactions per second. The rate at which the data compounds upon itself about consumer lending and spending and consuming behavior, that's massive. And there's no way in hell that I think a traditional banking system who has not invested into these BI data analytics can replace Qdian, right? I think micro lending is here to stay. And I actually think that's the future. Okay? And the reason why I say that, guys, is because here's a fact that you don't know. 2/3 of millennials do not have a credit card. They don't have a credit card, and they don't want a credit card, okay? Fast forward 10 years, it might be 3/4 or even 4/5. So just remember that, okay? So how's the bank going to tap this valuable market, and how are they going to serve these people? Okay, guys? So just keep that in mind for a second. All right, Weibo. Now, Shawn says, look, if you buy Weibo at $35, it requires a 50% growth, and it's a 50% margin of safety. So look, let's talk about Weibo for a second. So my question is, okay, why does it need a 50% margin of safety? Okay, guys, we cannot value Weibo like a traditional value investment. Okay, we have to take off our value investors' hats off. And like I said in the previous video that I made to this one, we can't really value tech companies like this, because if you just look at the price to book, there's no. I mean, how do you value the relationships that the users of Weibo and the followers have with their KOLs, right? I mean, how do you value that relationship? How do you value the network effect? How do you value user engagement? There's no way to quantify that in terms of book value, right? So we have to value this company a little bit differently. And so my suggestion is think about it not like a traditional value investment, but think about it like the tech company, okay? Their user base and how loyal and how engaged a social platform's user base is, there's no way to quantify that on the book value because no accountant will be able to tell you how much it's worth. And so that's why we have to interpret that in a different way and use our own research and our own sort of cognitive abilities to try and analyze this company, right? And so that's what makes tech companies a little bit tricky. So that's why you have to do a lot of research. Now, Shawn asks, can Weibo return to a 16% plus growth rate and have they got a moat? Now, my answer to that from my research, and again, guys, this isn't financial advice, this is just my interpretation of the research, is that I think they can, but I think that the suppressed growth rate is going to stay until Q2 of 2020, depending on how the Chinese economy is. And the reason why I say that is because if we pay close attention to the Q1 FY19 earnings call transcript, the CEO said that he believes that the ad oversupply in China will persist another 2 to 3 quarters. But I think this might be longer due to how much the Chinese People Bank of China or the Chinese government is stimulating growth. And also if we look at the things like the new housing sales numbers, new auto sales numbers, used auto sales numbers, and the general retail environment, okay? So yes, I think Weibo can return to that growth rate, but right now it's a buyer's market for advertising, not a seller's market, because like I said, things are slowing down a little bit, okay? Now, do I think Weibo has a moat? And the answer to the question is that I believe they have a moat, right? And the reason being is because, again, if we go to the Q2 FY19 earnings call, the CEO said the daily active users and monthly active user growth was higher than pretty much all of the previous quarters, and engagement was very, very high, especially in the interaction between the KOLs and the users. But the thing that made the most sense to me was the KOLs from Weibo have actually been attracting KOLs from other social media sites and bringing them to Weibo, right? So what they're effectively doing is they're actually poaching key influencers from other media sites and bringing them to Weibo, then getting them really engaged with all of the followers, right? And as a result, that's why I think the DAU and MAU growth in Q2 was higher than all of the other quarters, because, well, they're getting other influencers and their followers to come use the platform. Okay, now Facebook doesn't have any KOLs, and Instagram doesn't really have any. Not Instagram, sorry. Twitter doesn't really have any KOLs, right? You've got people who tweet and people that follow, But my answer to that question is you have to do some deep, deep research into the differences between China and America, right? Because I can tell you right now, people in China despise big brands, especially people our age and younger, right? So the millennials, Gen X's, Gen Ys, okay? The amount of just distrust people in China have for big corporate companies, especially in our age, it's absolutely nuts, right? And so that's why the KOLs are so influential, and that's why I think that Weibo has such a good moat with the KOLs. People follow these KOLs like sheep and lemming, okay? Like I don't know why this is so different between the West and the East, but I don't know. Maybe it's the way that people are brought up, or maybe it's how they interact socially. But the answer to your question is KOLs make a huge difference in Asia, and that's why I think you should do a bit more research into what that means, right? So if you've got Asian friends, or if you know some Asian social clubs, anywhere you can actually talk to people and just really get an understanding of how people think and behave, I think that's really going to help you appreciate the differences between Weibo and Facebook. So I hope that helps answer your question, Shawn. Okay. Now, Shawn, he's bearish on Qudian, but less bearish on Weibo because it's within his circle of competence. So my question is, why is Qudian not within your circle of competence, okay? My other question is, if you spent 100 to 150 plus hours researching Qudian, would that still be outside of your circle of competence, okay? Because I think what Shawn is saying is, he goes, look, Buffett and Peter Lynch, right? Greatest investors ever. They said, look, you have to play within your circle of competence. Okay, that's great, but that was 40 years ago. So how could they access information 40 years ago versus today? Okay, what's the difference between accessing information 40 years ago and today? So let's just think about that for a second, okay? Because back then, if you wanted to get information on stuff, there was no way. Like, where would you go? There was no internet, right? But today, I think most things, if we put enough time and effort into it, can be within our circle of competence, okay? So my argument to that is that because recently I've been researching a company called 2U who deliver online university degrees, all right? And most people today believe that you can get the same quality of education if you do an online degree. It's the same quality as if you do it in person, okay? That's why university today is offering, MBAs online, PhDs online, okay? Many students rate online education as high quality as in-person education. I don't think that we can say something is not within our circle of competence as a reason not to invest in it, because if we put enough time and effort into it, I can guarantee you that most things will be in your circle of competence, purely because of the magic of the internet and our ability to consume and access information that 40 years ago Buffett and Lynch would have never even dreamed of. Okay, so the exceptions are things like biopharma companies, biotech companies, mining companies, oil and gas companies. Okay, and the reason why I say this is because it's hard to get these companies in your circle of competence because of, first of all, biopharma. You need access to proprietary clinical test results and clinical trials. Now, obviously, you're not going to be able to get that because people are not going to publish it until they sort of, go and get an FDA approval for the drug, but then that's already out in the open, so the share price has gone way up, right? So you need sort of insider industry contacts. And things like oil and gas companies, okay? You need to actually go and visit the mines, right? So you need to study like some kind of geology degree, and then you need to go and visit the mines, and you need to go underneath the mine and then look at the mining structures and look at, you got to sort of look at the technical reports, and then they, sort of do the drilling, and then they do the, I guess the, like imaging. So they're trying to sort of digitally image the ore body that might be under, thousands of meters underneath the ground to pinpoint where this metal is and that metal, right? Okay, I can understand if you say that's not within your circle of competence, because, I mean, how many of us can just get up and go and visit a mine, right? But most things today, Weibo, Qudian, whatever, I think, most of us with an average level of intelligence, with enough research, can make it within our circle of competence. So I don't think that's a reason to not research a stock or not be bullish on a stock. So I hope that helps answer your question. All right, guys, this video is dragging on, so let's try and wrap it up, right? So any other thoughts on Chinese stocks? Look, only what I've done on Alibaba, Qudian, and Weibo. The only time I have a thought or an opinion on a company is if I have done a minimum of 40 hours of research on it, because, I really need to understand how the industry works, right? So I need to understand the economics, both the micro and the macro. I need to understand, all of the dynamics. I need to understand the competitors, all of that. And after understanding all of that, I only have a surface level view on it, okay, guys? So that's why sometimes when you guys ask me a question, do I have an opinion on a company, and I say, look, I don't, because I just don't have the time to research everything. So I'm very selective about what I research. Do you have any thoughts on Chinese companies being taken private again? And the question is, the answer to your question is yes. So if we read their Q1 FY19 earnings call, the CFO expressed his frustration that the stock keeps trading at depressed values, and he says that, look, they'll continue to focus for a couple of years on increasing shareholder value, but if people still aren't recognizing how valuable the company is, they'll just take it private. So yes, look, I think there's a massive possibility that Qudian gets taken private. Summary and risks, okay? Always do your own research, okay? Yes, great, I'm happy if you like my videos, but this does not substitute your own research, okay? If you do not know a company like the back of your hand, then you are speculating, okay, guys? And so, how do you quantify that? Well, look, I think a minimum of at least 120, 30, 40, 50 hours of research on a company is mandatory before you invest in it. Okay. Okay. So risks. A Chinese recession will definitely hurt Weibo and Qudian. There's no doubt in my mind. Okay, so don't invest what you can't afford to lose. Buying into a stock going up is silly. So I made this mistake with Qudian where I averaged up my buy price to 770. Very, very silly mistake. Okay, guys. So don't do that. All right. That's why in my previous video that I made to this about when to buy a stock, now I'm not interested unless it's dived at least 60 to 70%, and it's pretty much bottomed, and the sentiment is just abysmal. Okay, because look, you buy into a rising stock. The other people who buy in, they just buy in because everybody else is getting in. So it's not investing anymore. Okay, guys. So that's the lesson that I've learned. In my opinion, the intrinsic value of something is arbitrary. Okay, and the reason why I say that is because, again, share price is driven by the beating or missing of expectations, okay? And so, a company is only worth what people are willing to pay for it. Case in point, Qdian, it's a great company. It's a PE ratio of 3. It's growing at 50% a year, but yet the stock price keeps going down. Why? Well, because, sentiment's just not there to drive it up. So that's why I think, whenever we analyze stocks and then we get this intrinsic value based on some DCF or something, look, that's not an accurate way, okay? The accurate way is, what does the market think, and is the market right or wrong? And are we going with or against the market, okay? Because if the stock, if the sentiment is wrong for the wrong reasons, and then sentiment will shift, then I think that's a great reason to invest in a stock, okay? But if the sentiment is permanently going to be bad, it doesn't matter how good your company is, because, at the end of the day, it's an auction, right? In order to drive the price up, you need buyers, okay? And if people aren't willing to buy your stock, no matter how good the company is, the stock price is not going to go up, okay, guys? So I think, we should just sort of keep that in mind. And my final point, guys, is, look, don't limit yourself to valuing a company and investing just based on traditional value investing metrics, okay? Because this was invented 70 years ago, right? And there are, some things you just can't value with a PE ratio or a PB ratio or a price to sales ratio. The best example that I can give you is Qudian has 300 billion data points on how people borrow and repay and the likelihood of default. How do you value that with a price to book ratio? You can't. Same with Weibo's engagement with the KOLs, right? That has no book value. How do you value that? So, guys, I hope that this has helped answer your questions and really get you guys to, I guess, think in a different way when it comes to investing, okay? And I'm not saying, value investing is wrong, but I'm just saying, like I said in my most recent video, we have to evolve our thinking and investing process if we want to stay relevant. And until next time, happy investing.